Okay. Hi, everybody. My name is Tom Deutsch. I'm an agency owner with Symmetry Financial Group. I'm Director George and Janet Matthews. And I want to thank Scott Forehand for taking the time out tonight to give us an opportunity to learn more about the Debt-Free Life program that Symmetry Financial has put together. Scott has been doing this ever since its inception, and he flashed some numbers up. I did my best to memorize them of what he's been able to accomplish. It's pretty impressive. In the year and a half that he did this, what I saw was $25 million of mortgages being retired with your plans, over 1.7 million dollars in student loan debt, over 2 million in cars, etc. But this program that Symmetry is put together for us is, I mean, it's nothing short of astonishing. It doesn't work for everybody. I mean, let's be fair about that. But the people that it works for, it works very, very well. My own son, I put a plan in place for him to retire his student loan debt. And instead of being in debt for 10 years and having nothing to show for it, he's going to be in debt for 3 years and have about a $50,000 down payment on a house ready to go as soon as he's done his student loan debt. So, and he's done nothing different. No more money coming out of his pocket. This is just rearranging where his money is going, so he's getting it to work more for him. So without any further ado, Scott, I want to go ahead and again thank you and introduce you, and why don't you take it away?
Thank you, Mr. Deutsch, Deutschmans. I appreciate the intro, and thanks as always for being here and helping us out. So again, my name is Scott Forehand. I'm an agency director here at Symmetry Financial Group. Today is February the 11th, 2021. The time is about 5:40 in the afternoon. We're here today to talk about debt-free life. This is meant for agents that are on here. This is meant to be an initial presentation to your clients. And so hopefully you've invited some of your clients here, and this should be that first introduction to debt-free life to them. And this is going to be slightly different than the way that Symmetry typically introduces this program. I think of things a little bit differently than the way Symmetry does. And for me, it's a little bit easier to understand it the way that I do it. So without further ado, let's just go ahead and get started. Let me go ahead and share my screen and we'll get going. Here we go. So debt-free life. What is debt-free life? Debt-free life is a play on words. It is a proprietary offering from Symmetry Financial Group, and it is it's nothing more than a combination of two financial instruments that have both been around for a long time, but it's putting them both together. And it is truly a situation where the sum of the parts is greater than significantly greater than what you would think of as them by themselves. So this is a case where 2 + 2 = 20, not 2 + 2 = 4. So debt-free life, again, from Symmetry Financial Group. And what we're looking for here is these are the two main questions that we're taught when we're trained how to do this program. Are you 100% certain you're going to have a great retirement? Do you have some doubt? I don't know anybody that can answer that question that doesn't have doubt about their retirement. And if they don't have doubt about their retirement, then they either don't have a retirement or they're just not thinking about it. And then the other one down there, if I could show you how to get out of debt in 9 years or less, including your mortgage, without spending any more money, would you today? And that's something that we were just looking at, the metrics that we were looking at just a minute ago. That's actually, it's not just 9 years or less, because sometimes if you have people, if the only debt you have is a mortgage, it may not be 9 years or less. It might be 3 years, or maybe it might be 20 years, but the average that we're seeing here is about 15.7 years early. And the range that I'm seeing with these programs is anywhere from 3 to 27 years early. Okay. So it's not just 9 years or less, because it's going to be different for different people. And also different people are going to have different uses of these programs. Sometimes they are using it to eliminate debt. Sometimes they are using it to build a retirement income stream. Sometimes they're using it for both. And sometimes they're using it just as a smart business tool. So they can use, like for those of you that are agents, right now you're paying quarterly taxes. All right. So your money is sitting in your checking account paying quarterly taxes. Well, why don't you make your money work for you forever by putting it up into one of these programs and then taking it out when you need it and earning that positive number, the positive arbitrage that we're all looking to get. So let's move on. So if you're like me, this described you. This described me 2.5 years ago. I was working my tail off. The federal government was taking about 40% of what I earned at federal and state governments in the form of taxes through different ways that they can tax you. About 34% of my money was being spent just servicing the debt that I had, the debt load. I was saving about 3% of my income, which doesn't make a whole lot of sense, but that's all I could afford. And the balance, that 23%, that's lifestyle. If you can call it a lifestyle, all that meant was that I was paying the power bill, putting food on the table, putting gas in my car. That's not a lifestyle. That's subsistence. And that's not the way it's supposed to be. And that's certainly not the way that our founding fathers had in mind when they started this country. Couple of big things to observe here. The average American makes plenty of money in their lifetime. The average American makes about $2 million over the course of their life. And that doesn't mean they're, college graduates even. There are people that go out there and, they work that $10, $12, $15 an hour job and they'll make a good living over time. The problem that we have is that most Americans, that 3% from that last slide, most Americans only save about 3% of their income for retirement. And if you're into your 50s and 60s and getting ready to retire, you're in the heaviest earning stages of your life at this point. And all of a sudden, if you've been saving 3% of your money over time, you're going to drop from making $60,000, $70,000, $80,000 a year to being forced to make $60,000 total spread out for the rest of your life, provide income to you. And it's going to be a 60, 70, or 80% drop in your income level. And if you have any illusions about Social Security, it's going to be bankrupt in 2030 unless they do something about it. And we've all seen both sides of the aisle kick the can down the road. So they're not looking out for us, they're looking out for themselves, and we're going to be left holding the bag in the end. So now's the time to make a decision. Don't rely on the federal government. Don't rely on the state government. Don't rely on your 401k or your IRA to provide that income stream for you. Do something different that you have control over. And that's what this is about. This is the Debt-Free Life program. So as it says down there, is this the American dream? And I think everybody can say absolutely not. So when you start taking a look at your debts, and maybe you go talk to a debt counselor or a credit counselor or one of those folks, and I'm not slighting those people. They serve a purpose and they certainly have good meaning and a good intention. The problem is what they tell you to do doesn't really work. Work harder. There's going to be a maximum amount of work you're going to be able to do. Spend less money. That's a no-brainer. Save more, no-brainer. You can't spend less if you're not making more. You can't save more if you're not making more. You can go refinance your debt. All that means is, okay, I've got a $10,000 split 10 different ways. No, I've got $10,000 split one way. Does that make any sense? Your debt doesn't go away faster. It's still there. Consolidate. Nope, not the way to go. The only thing here that works with regularity is going to be that debt snowball. And what that is finding out your debts based on the interest rate that you're being charged versus the amount of money that you owe. And then taking that into consideration in a true debt snowball and looking at the different scenarios and all the different permutations to figure out paying off which one of them first is going to make the biggest difference the fastest. And when you're looking at this, for most people that I run into have 10 or 12 debts, there is only one best way to eliminate that debt. There's only one order. And luckily our software tells us that order. Our very expensive software. So moving on. So our better way, eliminating the debt, making the debt work for you, changing the paradigm, changing the discussion, make it so that I'm not really worried so much about how much debt I have because I can see the light at the end of the tunnel. I can see that in 7 years, my house is paid off. My cars are paid off. My 401k that I've been overfunding and it's been losing money. If anybody's been paying attention to the world equity markets recently, we're in for a heck of a ride. And we're looking at, well, never mind. Take a look at the world equity markets. You're going to see what's getting ready to happen in the next year or so. And it's not going to be pretty. There's a way that we can avoid all that unpleasantness. And that's by taking control of our destiny, taking control of our situation, putting our money in a situation where it's going to work for us for the rest of our lives and making it so that we can use our dollars over and over and over, becoming the bank, which is what this is, again, what this is about. So we want to get you from the left side of the screen to the right side of the screen. We want to make it so that you're going to have a 500% increase in how much you're saving for retirement. We want to make it so we're going to reduce the amount of taxes you're going to pay over time by 25%. We want to increase your lifestyle 20, what is that, 20%, 23%? These are huge numbers. So if you can think of this for a second like this, you know your finances. You know at the end of every month, you've got X amount of dollars left over. Maybe it's 100, maybe it's 1,000, maybe it's 5,000, maybe it's 400. We'll use 400 as a nice number. So if I increase your lifestyle, if we increase your lifestyle by executing one of these programs, and we go from that $400 being representative of a 23% lifestyle, and we increase that number by that factor, go from 23% to 33%, that's not a 10% increase, boys and girls. That's over a 40% increase. So if I increase your $400 a month by 40%, maybe I'm getting you to $600 or $700 a month. That's a huge difference for a lot of families, especially in this day and age. And more importantly, I'm going to significantly reduce that interest number. And that interest number, that's the interest we're paying over time. And if any money that I'm saving you in interest, or we save you in interest, and any money we save you in taxes, it shows up in that savings piece of the pie, and it shows up in that lifestyle piece of the pie, which means ultimately we're saving it for the future. And what a future it is with one of these programs. So how do we do it? Well, we reduce the interest you pay to lenders. How does that happen? That's because we do things the lenders don't want you to know about. We pull out the stops. We use all those little tricks, doing bi-monthly mortgage payments, doing mortgage chunking, making payments when they don't expect it. If you got $5 just laying around, send it off. That's $5 less interest that can be amortized. We're going to reduce the amount of tax you pay over time. Why? Because our focus here is that when we take the money out of this program, we're going to take it out. No matter how you look at it, we're going to take it out in a tax exempt manner. Yes, boys and girls, I said tax exempt, not tax deferred, not tax advantaged, although this is, from my perspective, the most tax advantaged way you could take it. We're going to take it out in a tax exempt manner. How's that? We're going to take loans. We'll let the system pay the loans off for us, and we're going to take a loan. So when you bought your house, did you have to pay tax on the money you used to buy your house? No. When you bought your car, did you have to pay tax on the money you borrowed to buy your car? No. Why? Because loans are tax exempt. So we're going to take a loan. We're going to take a loan from our private bank that we're going to create. And we're going to decide if I'm worthy enough to lend myself money. And if so, how much interest am I going to charge myself? Let that one sink in for a second. We're going to improve your cash flow. How so? That's that lifestyle. We're not trying to strap you here. We're not trying to create an additional bill. We're not trying to make things tighter for you. We're trying to loosen everything up. And the main reason why that is because I know if I said, you know what, Adrian, I want you to go out and I want you to eat ramen and tuna fish for the next month. And I want you not to go out and have a cup of coffee at 7-Eleven ever again. I want you to brew all your own coffee at home. I want you to grind your own beans, the whole 9 yards. If I told you how to do all that, you'd probably do it for about 2 days. And then you'd say, Forehand's full of crap. Okay. So the idea is we want to put you into a situation where what we tell you to do, what we show you to do, it's not only feasible, but it's easy. And we want you to see that immediate return, which you're going to see in that lifestyle. And then when you pay that first credit card off that you were supposed to take 2.5 years to pay off, but you just paid it off in 7 months, that's when that light bulb goes on and you're going to say, aha, Nancy Hardy was right. Tom Deutsch is right. This really works. And then all of a sudden you're paying off that second credit card 4 months later, which should have taken you another year. And then you're like, oh, wow, Misty Hutton knows what the hell she's talking about. Okay. Finally, that last piece there, allowing you to retire with a tax favored income. It is the most tax favored that there is, which is 0 taxes, right? All right. So There's this system that we're talking about uses two components. One's called infinite banking and the concept of infinite banking, which has been around for a long time. And another is called debt snowballing, which has also been around for a while. We're not talking about debt stacking. We're talking about true debt snowballing. And there are other programs that have come for us that have tried to do what our system does. They've tried to execute and have the result that we have every time. But in those past iterations of these plans, of these programs, they've all failed, and they all fail for a reason. And the most common reason they fail for is because they don't plan for the unexpected. So our system by default captures, sequesters, and hides about 20% of the money that's available to you in your system. And that's why our system doesn't fail, because when that emergency purchase comes up, when you need to replace that transmission, or it's going to be 4 months before State Farm can get around to replacing your roof and you need a roof now, you've got the money available to you now. Okay. So that's what we're talking about. We plan for the unexpected. That emergency fund, it's truly an emergency fund. It is there. It is hidden by default, and you can get to it if you need it. So why not do a 401k? Why not do a Roth, right? So these are standard tax deferred and tax advantaged retirement programs that we all know about. We've all heard about. We've all been fed that line that says, put your money into your 401k, because later on when you're older, you'll be able to take it out at a lower tax rate than you're taking it at now. And that's the lie. Because the lie is, as long as our government keeps spending more money than it makes, taxes are going to go up. And as long as that can, and there's no, I don't care which party you support, they both do it, right? Neither one of them has our interest at heart. So in this scenario, putting the money into a 401k because you're going to be at a lower tax rate later is incorrect. You're going to be at a higher tax rate later. You may be at a lower tax bracket, okay, but you're going to be at a higher tax rate. And so when you run these scenarios side by side, a Roth versus a traditional IRA, traditional 401k, versus something where you pay the tax right now on the money that you make and you put in the program, and any money you pull out ever is tax exempt, there is no way in the world a Roth or an IRA can compete with this. There's always going to be less money at the end of the rainbow with those other programs. And that's just because of the way the money works. The minute you pay your interest on it, you're done. That's the last time you're going to have to worry about it with our program. With those other two programs, with the Roth, with a traditional IRA, traditional 401k, KEO, TSP, FERS, whichever one you're doing, they're all going to have a tax event at some point, which is going to make your ultimate nest egg be smaller. Okay. So moving on. So like most financial instruments, they operate in phases. So debt-free life is no different. And these are the 3 phases on your screen that you see right now. Maximization. That's the phase where most people are at when you first start these programs. What we're doing during the maximization phase is we're creating a debt snowball as quickly as we can, so that we're going to eliminate that debt as quickly as we can. This is assuming you never make a pay raise. This is assuming you never start making more money. This is also one very critical consideration, which is you are currently able to support your debt service. So if you are unable to support your debt service, if you're considering or contemplating bankruptcy, this is not a scenario for you that's going to work. You're going to have to bite that bullet. Okay. But as long as you're able to support yourself and support your debt service, then you can execute one of these programs. I've seen these programs work for as cheap as $65 a month. Okay. So it doesn't mean you have to have a lot of money, and it doesn't mean you have to throw a lot of money at it. The trick with these is the more debts you have, the better it works. So if you've got someone who owes $100,000 with one debt and someone who owes $100,000 with 12 debts, this person's going to get all their debts paid off about 60% faster than this person. And that's because of the debt snowball, right? So we're talking about infinite banking the concept of infinite banking, keeping that money, using it over and over and over, using it forever. When you couple that with true debt snowballing, this is a juggernaut. And this is, we've all heard, which is incorrect, that adage that was attributed to Einstein, which says there's nothing more powerful than the effect of compound interest, right? That's an amortization schedule, compound interest. What we're doing is we're turning debt on its head. We're making that compound interest, instead of working against us, work for us. And in the process, we're making a ton of money. So let's say you get out of debt and you're done, and you've got that debt snowball fully rolling, and you've got all that money that you were spending on debt service is now going into your program every month. Then you have reached the accumulation phase. This is the maximum rate at which you're going to accumulate money in your program. And it's going to be huge. It's not nothing you've ever thought of. It wasn't anything that I ever thought of before I started seeing these things. And then finally, the distribution phase. That's when you can allow yourself to have that emergency jet ski purchase, that emergency trip to Tahiti, that emergency trip to Austin to go get some kick butt food. Okay. So the point that I'm making here is everything happens in time. Everything happens in order, and everything happens for a reason. And the reason of the maximization phase is because you need to build that snowball. The reason you need to build that snowball is so you can really, really accumulate cash during the accumulation phase. And the reason why you want that to happen is so you can really, really live that life of Riley in the distribution phase. Okay, moving on. So I mentioned that this is not a new program. Debt-free life is new, but the concepts of infinite banking and debt snowballing are not new. In fact, Walt Disney, Doris Christopher, Ray Kroc, Warren Buffett, they've all done it. They've all used this scenario. Ray Kroc did it with about the first 6 or 8 McDonald's franchises that he opened, not franchise, but facilities, locations. Warren Buffett does it to this day. The concept of infinite banking is not new. It's been around for a long time. Problem is you see something in common with those people on your screen? Yeah, they're all super wealthy. Okay. The concept of being super wealthy and having these programs available to us, it wasn't. These programs, in order to set these programs up correctly, previously, you had to have a large cash influx at some point beyond what most of us are capable of. We're talking 7 figures. And so the problem is, yeah, it was available, but no, you couldn't do it because we didn't have enough money. Well, thank you, the 3 carriers that we have to do this: Foresters Financial, Lafayette Life, Mutual Trust Life, because those 3 companies have created programs that we can now use. And for those of us at Symmetry, those are the carriers that we use to facilitate these programs moving forward. So life insurance. Why life insurance? It stems to specifically IRS tax code 7702, which for everybody who's on this call, if you've been paying attention, in January of this year, 2021, they made 7702 even stronger than it was in 2020, which means you can actually capture even more money now than you could have previously in a tax exempt manner. So how do we do this? The third bullet there, we borrow from the policy's cash value. Every time you take a loan, it's borrowed money, and there is no taxation on borrowed money. We're going to use that 4th bullet, pay off your debt to 9 years or less. We're going to use that paying off of your debt in the maximization phase to get that to the point where you're debt free, and we've really maximized our accumulation phase. So everybody that I talk to, when you first hear about this, they have one major pushback, which is this. Okay, Derek Major, I just took a $50,000 loan out of my debt-free life program. Who's paying it back? That's everybody's big trip. That's everybody's big trip up with this. The reality is, and I mentioned it earlier, this program typically receives or experiences what's called positive arbitrage. All arbitrage is borrowing money at a lesser rate than you're getting paid when you lend it out. So remember what I said, you're creating a private bank, right? You're the one who decides how much interest you're going to charge yourself. Me, I'm charging myself 0% interest because I think I'm worth it. And I'm going to continue to do that for the rest of my life, right? And I'm going to let the positive arbitrage that's built into my program, 17 out of 20 years, I'm going to get paid more interest than I'm being charged to take the loan. So if I never pay the loan back, this is a juggernaut. It gets paid back automatically. It gets paid back because we're experiencing positive arbitrage. Now, let's say I've gone through the process and all of a sudden one of those emergency things happens. I can take the cash out, which you should never do. Don't ever take the principal out, leave it alone. Or I can take a loan. I'll take an emergency loan and I'll go ahead and I'll buy that new water softening system for my house because I just closed on my house, and that's great. So now I owe $6,000 more than what I did before. And this, I'm telling you this because this is a scenario that just happened with one of my clients. They went $6,000 more in debt than when they started the program. But what actually happens is we turn debt on its head, and that particular person's program is now going to get them out of debt because they added $6,000 in debt. They're actually going to get out of debt 2 years earlier. And oh, by the way, because they're fairly young, they're in their 30s, they're going to have $80,000 more at retirement than they would have if they hadn't added that $6,000 worth of debt. And that's a hard concept to get through. And I get it. And I understand it. It doesn't make any sense. But the math doesn't lie. The numbers don't lie. And these numbers, this is a contract. This is a contract with the carrier. So you've got recourse if it doesn't work the way it's supposed to. But if it doesn't work the way it's supposed to, then that means you probably didn't do something you were supposed to do. All right. So now, legacy, biggest thing here. This is a small thing for us because most of us are stuck in today. I'm concerned about today. I might be concerned about tomorrow. I'm not thinking what's going to happen 90 years from now. But that's the kind of legacy you can leave with these programs. And this is how the richest people in the world, the Rockefellers, the Kennedys, okay, this is how these people have been doing this for ages. If I put money into a life insurance policy and then I make Adrian the owner of that policy, then I've transferred money to Adrian. I'm not talking about money laundering. I'm talking about transferring within the family. It's not money laundering, okay? And when I do that, then I have essentially transferred wealth from one generation to the next generation without taxation. Okay, so that's what we're talking about, legacy. So Nancy Hardy, in 60 years, when Nancy Hardy has a great grandchild, she could peel off a piece of this and make that great grandchild have a legacy. So that great grandchild starts with 7 figures sitting in an account for that child's life. And then they do the same thing 3 generations down the road. This is what I'm talking about. It's creating generational wealth, not next generation, not my children, not my grandchildren, but my grandchildren's children or my grandchildren's grandchildren. This is the capacity of these programs. So this is a very old slide. This is when we first started doing this. And those numbers are accurate, although they're very, very light. When I see the amount of debt that we're eliminating on people, 100,000, that's nothing. 73,000, that's nothing. 84, that's nothing. We're talking typically 400,000, 500,000, 2.2 million for one of my clients, right? So this works. It works like a charm. It works as long as you follow the system. All right, let's go a little bit deeper. So let's talk about how you spend money. Right now, the way you spend money is you make your money, however you're making it, 1099, W-2, falling off the mail truck, who knows, however you make your money, right? That money, your income gets deposited into your bank account, Wells Fargo, Citibank, Navy Federal, SunTrust, whoever you bank with. And then that bank decides that they want to thank you by putting your money in their bank. And the way they thank you by doing that is they lend your money out every night and make money with your money. And they don't give you a penny. Thanks for letting us have your money. The average dollar that you put into your checking account with whatever bank you bank with is lent out 7 times before you actually spend it. How many times are they giving you a deposit for using your money? And I would venture a guess that it's probably 0 or maybe 1. So at the end, you have this situation where you have to pay a debt, whether it's your car payment, a credit card, whatever, doesn't matter. So you tell the carrier or your bank to pay the debt. And the way they pay the debt is you stroke a check or you do a bill pay or whatever. You cause the bank to send money to your creditor. Your creditor says, thank you very much. And then what has really happened is you've transferred your money to them. Your money's gone forever. It's now their money. The only person who benefited from this whole situation was your bank, and they got to use your money and make money with it 7 times before you spent it. Does that make anybody mad? It makes me mad. So there's a better way, and that's our way, the debt-free life way. So the same thing starts off. You're still making money the way you normally make money. Maybe it's mailbox money. Maybe it's mail truck money. Maybe it's a 1099, like most of us here on the call. You deposit that money into your checking account, regardless of what bank it is. The bank's going to try to do the same thing. They're going to try to use your money over and over. But aha, we're going to stop them in their tracks. How's that? We're going to take out a life insurance policy, a whole life insurance policy. This is a special kind of life insurance. This is not your mother's Gerber policy they took out when you were knee high to a grasshopper. This is a participating whole life. And one of the other things we have to do in order for this program to work correctly is we have to create an umbrella so that we can stash all that cash underneath. And that umbrella comes in the form of a term life rider. And what that term life rider is it increases the total amount of life insurance so that we can take advantage of IRS tax code 7702, part of which says any money derived from a life insurance policy is tax exempt. And the other part of it says if there's more cash value than there is life insurance value, that it's not a life insurance policy. And then the whole thing becomes taxable. The whole thing comes crumbling down. So that term life acts as that umbrella, and it keeps the IRS from intruding onto what we're trying to do. And the final part of this trifecta is a paid up addition. So what is a paid up addition? It's life insurance. What is term life? It's life insurance. What's whole life? It's life insurance. So this policy, singular, one policy, is a whole life policy, a participating whole life policy. Participating means that because we're doing this special kind of policy, we're going to get to participate with the profit of the company that we place this policy with. Okay? What does that mean? If you take out a traditional whole life policy, you might earn the same kind of rate that you're going to get with your bank in a savings account. You might earn 0.25% like Bank of America. You might earn 0.5% like you do with Wells Fargo. Okay? That's a traditional whole life policy. With a participating whole life policy, the stakes are much higher. So for example, with the carriers that we use, the whole life guaranteed return is 4%. You're getting a 4% interest, and it's compounded. Some of our carriers compound it monthly. Some of our carriers only compound it annually. Okay. And I think if you do the math, you'll find out that something that compounds monthly is going to be way stronger than something that compounds annually. Okay. The term life rider is there only to serve as the purpose of an umbrella. And as the life insurance that we purchase every time goes up, eventually we don't need the umbrella anymore. And that's the last part of this, that paid up additions. So when I make a single payment, and I'll use $1,000 as an example. No, I'll use $100 as an example. Let's say I make a single $100 payment to my life insurance policy, my participating whole life policy. As soon as it hits the carrier, it gets split into 3 parts. Part of it goes to whole life, part of it goes to term life, part of it goes to paid up additions. And the way that we structure these, somewhere between 60 and 70% of that payment is going to go buy paid up additions. Let's dive a little bit deeper into paid up additions. What is that? That is paid up life insurance. So, Adrian, you're nodding your head. Let me ask you this, Adrian. If I buy $100 worth of paid up life insurance today, how much is it worth tomorrow?
If it's paid up, it's $100.
Right. How much is it worth a year from now?
It's $100.
How much is it worth 10 years from now?
It's still going to be that.
$100. So the value that I purchased never decreases. Okay.
Right.
So if you take into consideration the devaluing of the US dollar, then you would think, okay, well, it never decreases, but it really is decreasing over time. Nope. Because this program pays you 4%. And that paid up addition the value of your paid up addition, that 4% gets applied to that. One more thing I want to make everybody aware of. Whole life, term life, paid up additions. 60 to 70% is going into paid up additions. About 11% is paying that term life rider. That means on average, 21% is going to the whole life core policy, right? How much of it's paying for life insurance? About half. What's happening with the other half of that money? Cash. This is where I was telling you that the cash accrues, it's growing. And this is where it grows. It's hidden. It's there, but it's hidden. We don't want to make it easy for you to get to that money. We don't want you to pull out the principal. We want you to leave it alone. That's why it's hidden, but it's there and it works for you. So $100, the standard that I use, 68% goes into the paid up additions, 11% goes to term, 21% goes to whole life, of which 10.5% goes to cash, 10.5% goes to pay for that whole life policy. So that's how your dollar gets split. The cash and the paid up additions is what that 4% guaranteed return, guaranteed interest gets applied to. And on top of that, every year, remember, participating whole life. So we're not just participating in the form of getting a high guaranteed interest rate, we're also getting a dividend. So remember when I said that the positive arbitrage that you're experiencing is going to pay you more in return than they're charging you to take the loan? That dividend over time is what's going to end up paying down your policies for you. Okay. So now, if you remember in the last illustration where you were, the way you normally spend money was the bank was making money with your money over time. And what we did is we threw the bank a curveball and we wrote a check out of our checking account up to our life insurance policy and made it so that our life insurance policy received some money. And we've moved that circle where you can reuse the money, the red circle, we've moved it from, instead of hovering over the bank, allowing them to use it over and over, we've put it on our playing field. We've put it into our bank. We've moved our money into our bank, our debt-free life bank, our paid up addition bank. They're all the same thing. They all mean the same thing. Okay. All right, Forehand. So how do I get my money out? Well, you don't do what I told you not to do, which is take out the principal. What you do is you say, you know what? I'm going to make a payment on my credit card and I'm going to pay the whole damn thing off right now. But I'm not going to pay you using my money. I'm going to pay using somebody else's money. I'm going to take a carrier loan and I'm going to use the carrier's loan to pay off my credit card. The money gets deposited into my checking account. I tell my bank to go ahead and pay the payment. The payment gets sent, however, whatever method you're using, to the lender or to my creditor, and now that debt is paid. Do they care where the money came from? Do they care that it was a loan that got deposited into my checking account and then they received the money? No, they just want the money. Okay. Does my carrier care that I borrowed money? No, because this is working and I'm going to continue funding my program. They're going to keep paying me because rest assured, if they're paying me 4.5%, 5.5%, 6.5%, they're making at least twice that with my money. They're investing money in the market. They're hedging. These guys know what they're doing. The most successful and profitable companies on the planet are life insurance companies, people. This is why they want to do it. They want you to give them more money so they can make more money. And oh, by the way, participating whole life, we want them to make more money too, because that means we're getting a bigger dividend, right? So that's the difference between how you spend money versus how you could be spending money with a DFL program. So now let's see it in practice. So I'm going to go ahead and show you a company, this is a group, a family that I worked on. This is back from Halloween of 2019. This family was a typical blended family, meaning they had both the husband and the wife had been married previously. They both had additional homes they brought into the property. That's why you see down here personal residence and you see the other property. These are two separate properties they own. But the biggest debt they had, well, not biggest, but the longest debt they had was actually a student loan. The woman, the wife, was a PhD student. She's now a PhD. She teaches, but the point is she had a lot of debt. How much debt? When you added it all up, they had $585,000 worth of debt. And that's the illusion that most Americans, that's the trap most Americans fall into. They think, yeah, I owe $200,000 on my house. Is that how much you owe? Nope. If you saw your amortization schedule, you'd know what I was talking about. So when you actually take into account the interest these people are going to be paying over time, their total debt is $767,000, almost $250,000 more than what they originally anticipated. If they paid their debt the way that they were going to do and stayed on track the way they were going to stay, it would have taken them 40 years to pay off their debt. Why? Because they had student loans. And what are student loans? They are evil, everybody. Evil, right? So what did we do for them? They made good money, and they certainly had the ability to afford some of these programs. So what we did with them, we just changed the way they were spending money. Instead of them putting money into their bank account and paying a little bit here and a little bit there, letting the bank use their money over and over and over again, we put their money into a private bank, into their own PUA bank, into their own DFL bank. And we used the money over and over and over again for us. And we got them out of debt in 7.8 years. That's a lot, right? It's pretty good. How good is it? Well, the gentleman, when we talked to him, he's 36 years old when we started this program. He told me he was probably going to work forever. He owned a trucking company, which had one truck. Okay. And he made good money. His wife was making okay money. She was teaching as a master's level teacher, but now she's a doctorate, so she's making even more. But more importantly, at the end of 40 years, they would have had zero other than the equity in their home. Okay. At the end of 40 years using our program, they're going to have $4.8 million cash sitting into their program. They're going to be completely debt free. Yes, we're saving them $70,000 in interest. If there's anybody out here on this phone that wouldn't take $70,000 in a heartbeat, then you're in the wrong place. This isn't for you. Okay. I'd take $70,000, but that's not the real deal here. The real deal here is how much we increased the efficiency of their dollars, how much we put it so that their dollar was able to be used over and over and over again. And oh, by the way, if you see that last little line, not only does this create $4.8 million cash for them, is there anybody out there that can't retire off $4.8 million? I think I could retire on $4.8 million, right? It also created an additional life insurance policy that was fully paid up of $1.1 million. So did we change this family's course? They're good. They're going to have a good life. They're going to have, multiple properties, multiple sources of income, all that stuff. Did we create generational wealth for them? $4.8 million is a lot of money. And how much money is that if you put it into another program that runs for another 60 years? What's the compounding look like on that, right? So this is what I'm talking about. This is how you create generational wealth. And these people, we didn't do anything for them. We didn't say go out and get another job, stop eating what you're eating. We didn't do any of that. All we did was change the way they were spending money because they were spending it inefficiently. So here's how it worked for them. Every one of those yellow bars is a year in which one or more debts are paid off. There's a couple of key things I want you to pay attention to. In that first year, if you look at that loan payoffs column in the middle, loan from CV, loan from cash value, they borrowed $14,900. They paid off $14,900 in debt in their first year. Okay. Not only did they borrow $14,900, but if you look at that next column, the EOY loan balance column, that's end of year loan balance. Not only did they borrow $14,900, they also paid back $6,300. So they borrowed it in the same year, paid it off, borrowed it, paid it off, borrowed it, paid it off. We're using the same dollars over and over. That's the only way that's going to happen. But there's one more thing I want you to take a look at. See that last column, the annual liquidity column? They borrowed $14,900, have $8,600 left on the loan, and they have $12,000 sitting liquid in their account in the first year. That's because the debt snowball in this particular case took effect in month 7. Okay. And once that snowball starts, as long as you stay with the program, it is a juggernaut. And you only have to look to year 2 to see the juggernaut. In year 2, they paid off another $15,000 in debt. More importantly, they paid off the balance of that first year's loan, $86.29, paid off most of the second year's loan. So they're only left with a loan balance of $77.93, And oh, by the way, they still have $40,000 cash sitting in their account and a liquidity column. This is not a test subject, folks. This is a real family in Chesapeake, Virginia. And of course, once you do this for your clients, they're going to think you're walking on water. And I'm not. It's just math. And then look at the next year. Now our snowball is really rolling. In year 3, we're paying off $58,000 worth of debt. We've paid off the entire loan from the second year, and now we've got $48,000 of loan from the third year we still have to pay off. But look at the third column, land liquidity. We've still got almost $30,000 cash sitting in our account. So at that point, if you remember the numbers of debts this particular family had, it was substantial. There was a lot of debts, plural, right? We've paid off all of the small debts by the end of the third year. The only thing that's left, the evil student loan and 2 family houses. All right. So in the next year, because of the way the software illustrates this, we didn't take a loan. In the next year, we paid off $31,000 of the previous year's loan. And then how much liquidity do we have at the end of that year? Everybody see that number? $91,000. The debt snowball is a juggernaut. The interest rate has kicked in. The compounded interest has kicked in. The dividend has kicked in. We are firing on all cylinders. Okay. And then the next year, we pay off a house. Then the next year, we pay off the student loan. And that last year, year 7 point whatever, we're paying off the final house. Did anybody have a holy cow moment there?
Yep.
Yep. Right. Okay. So that's a standard family example. Let's say you don't have a family, you don't have a student loan, or you don't have a mortgage. This is a student that I did this with. This is a master's student. She's at Caltech right now working on her master's in oceanography. She works as a waitress. And at this point in her life, she's over $90,000. She's $85,700 in debt. Okay. And if you look at the interest that she's expected to pay, she's going to pay more interest than she owes in principal. This is sick. Why? Because I told you earlier, student loans are evil. Okay. So she owes $85,000, but with the interest on all those student loans, it's going to take her 40 years to pay it off. This is assuming she never gets another job working as anything but a waitress, and she never throws any more money into this program other than the 350 that her program was structured on. So what do we do for her? We got her out of debt in 9.7 years. More importantly, she said she wanted to retire at 65 because she thought she could. Well, we got her retired at 50. We also got it to the point where at the end of 40 years, where she would have been at 66 years old, or excuse me, at 63 years old, she would have had 0 to show for it. But we got her $603,000 cash sitting in the bank. Again, don't forget, assuming she never gets another job, never makes more money than she's making right now, doesn't ever do anything but work as a waitress the rest of her life. And there is nothing wrong with waitressing. Okay. I've owned restaurants before. They're the salt of the earth people. Love them. Okay. But it doesn't have to be that way. And more importantly, this is, if she never has a family, she still created a $400,000 life insurance policy that's fully paid up and she never has to pay for again. Remember paid up additions? It's life insurance, right? Keeps piling on and piling on. Every time you make a payment, you're buying more life insurance and more life insurance and more life insurance. And eventually that paid up addition life insurance becomes the umbrella, and we can let go of the term because that umbrella is now hiding the cash that's in the program, right? Beautiful stuff. So at 50 years old, she's got $294,000 sitting in the bank. She's got no debt. And if she wants to stop making payments, do the math with me. This is really cool, right? $294,000. She's paying $4,200 a year into the program. She stops. So the next year we have $316,000. That's 16 plus 6. That's 22. So she gained $22,000 and she paid $4,200. But let's say she stops paying at age 50. That means 22 minus 4 is 18. That means we just created an $18,000 a year tax-free income for her for the rest of her life. She never has to pay for it again. And oh, by the way, that death benefit continues to creep up. It's now at $700,000. Okay. So that's how these programs work. What do you need to do next? If you're an agent, you need to go out and help some people put some of these things in place. If you're not an agent and you're here because you're checking out these programs, you need to get up with whoever sent you here and you need to start the paperwork on one of these things. Okay. The only downside to these programs that I can tell you, there's two. The first is they take a long time to put in place. Okay. Many weeks to months to put in place. And the second thing is a lot of people, when you're given an opportunity to have 30, 40, $50,000 sitting in an account that you control and you haven't been in that situation before, all of a sudden that jet ski, that emergency jet ski purchase looks like a good idea. And taking that trip to Las Vegas with $10,000 in your pocket sounds like a good, sound financial investment. And then you defeat the whole purpose of the program. Okay. All right. So that's the end of the debt-free life piece. We've got a little bit of time left. We got 17 minutes. No, 27 minutes. No, 17 minutes. Math, not my strong suit today. So I'm going to do one more quick thing. Nope, we'll just stop there. Let's go ahead and do this. I'm going to open it up for questions. Thanks, Scott. Got around. Bye, Rebecca. Okay. That's the only question that's in the chat. Does anybody have any questions? If you do, unmute yourself and ask away. Everybody got it. Awesome.
This is Dennis.
Hey, Dennis.
Why did you say earlier that the program might work even better for people in unhealthier conditions?
Right.
In rating for instance?
Okay. So this is an advanced concept, but the way the tax code, IRS tax code is written, 7702, it doesn't talk about the amount of life insurance. It talks about the expense of life insurance. So when you have somebody who's less healthy, the expense of life insurance goes up. Okay. So the amount of coverage you have goes down, but the expense goes up. As the expense goes up, the amount of PUA bank you can create also goes up. So the amount of PUA bank you can create with these programs is directly related to the cost of life insurance and actually inversely related to the amount of life insurance.
Okay, thank you.
Okay. Anybody else?
Yeah, Scott, this is Adrian.
Hey, Adrian.
When you're presenting this to your client, customer, family, with all of everything that you're doing, do they get lost in what you're doing? You're having to slow down to go, and then you're going, hey, listen, this might take a while to get everything set up.
Every time.
Okay.
Yeah,
because I was wondering, because you're one of the best in the company at selling this, and yeah, I got a book by Garrett Gunderson who does the exact same thing. I about fell out of my chair. That's why I was shaking my head and smiling so much. I went, holy cow, here it is.
Right. So the reality is this is such a foreign concept to most people that very, very few of them get it first attempt. And it's nothing on them. I didn't get it in the first time I got through this. I went to that training class and I was lost. And it took me weeks with a lot of reading and a lot of studying and a lot of talking to some of the other people here in the business and getting my training. So this is not an easy to grasp thing. And there are so many moving parts to this, it becomes overwhelming quickly. Okay. So all I can say is stay the course, take it slow, small bites, use the concept of this is how you're spending money now. This is how you should be spending money. Use the concept of explain how the banks do it, and then use that and say, we're going to become the bank. Instead of us letting the bank use our money 7 times over, we're going to use it 7 times over.
Yeah. Like I said, thank you.
Sure.
Read about this, and it's like verbatim. I mean, he calls it cash flow banking. He came out of a book called What Will the Rockefellers Do?
Yep.
Same stuff.
Yep. There you go. Right on, Leah.
Hey, Scott, if I could just chime in, one one of the most educational things that I did, Adrian, was I set this up on my son, the engineer, who raked me over the coals for weeks with questions on how does this work, and really the concept that resonated with him the most was when I said, when you put money in the bank, you get interest, right? And they're protecting your money, and it's in a safe place, and you get to write checks off of it. And he said, yeah. And I said, you get like 0.25% interest, right? And he said, yeah. I said, that's not what's happening though.
Right.
What's happening is the bank is borrowing money from you at 0.25% interest and lending it to somebody else at 7%, 10%, 20%. Once he was able to step into that position, he began to realize, okay, we're doing this, and the insurance company is giving us the ability to, as Scott says, a fancy word, positive arbitrage. But once he got the concept that the bank wasn't doing him any favors at all.
Right.
The bank was borrowing money from him to lend to somebody else. Once he figured that out, the concepts came a lot faster to him. But up until that point, it was too good to be true. And he's my own son. Finally I said, Ted, come on, give your dad a break here. It was very educational for me, though. It was very educational to run down these questions that he asked. So
Tom, quick question for you.
Yes.
Okay. What are student loans?
Student loans are a total ripoff.
There's one word. What are they?
They're evil.
It's thievery.
They're evil, right?
They're evil.
Yeah.
It's thievery.
Yeah.
It's absolute thievery.
Who makes student loans?
The government.
Banks.
The government. Well, okay, they're subsidized by the government, though. I think.
So by default, student loans evil, banks evil.
So here's the question I have: how could it possibly be that it cost me the same amount of money to go to college for 4 years at an out-of-state college, out-of-state school, as it cost my son to go to 1 year of school at an in-state college with a scholarship? And I've done some digging in this, and it all goes back to the once the student loans were guaranteed by the federal government, universities set up. There's no limit to how much we can
cash
charge.
Cow, right? Yeah. We all have a dollar sign as we're walking around, and that's why we're all encouraged to go get college degrees. And I have 4, and I don't use any of them. Complete waste of money.
Well, not a complete waste.
All right.
Oh yeah, the first degree got me into the school for the next degree, and that degree got me into the school for the next degree, and then that school got me into the last school for the next degree, which I don't use.
But
right,
I got to tell you, if we could introduce this to kids right out of college and parents of kids right out of college, the entire trajectory of their life will change.
Yep. My
son, thank God, had a scholarship. My other son did not. $120,000 in debt, graduating from Penn State, an in-state student, 120 grand. And he's got a job, and we're sitting down to talk about this. He's going to be out of debt a lot faster. Right now, it's going to be 40 years.
Yep. I'm working with a program right now that finances medical loans, medical student loans. And they're going to be rolling this out to 2,500 physicians to help them eliminate their medical school loans in less than 10 years, as opposed to the 30 that they're currently looking at.
It's robbery. It really is robbery. And sorry, we're on a soapbox right now.
Right. All right. So let me answer some of these questions in chat.
Okay.
From Liz, Scott, what's your recommendation for new agents? Go take the DFL training, talk to your upline, get appointed with the carriers that you want to write business with, and go do it. Go help a family. Go get rid of somebody's debt.
Write one of your own.
Yeah.
Write one on you.
You should.
Family member.
Absolutely. If you're an agent or if you work in a 1099 arrangement, you absolutely should have one of these on yourself. It's what, Adrian and I were talking about at the beginning of this. You should put the tax money up into the program, let it sit there forever, and then take it out when you need it. And when you take it out, you're taking it out as a loan, which means your money is still there forever. Okay.
Scott, quick question for you. I didn't mean to ask you. I had to jump off because a client called. Did you
We talked about you while you were gone, yes.
Okay, thank you very much. Did you use the escrow example as a way to fund one of these? Okay.
Nope.
Would you take a...
Let me answer these questions that are in chat first.
Okay.
And then we'll talk about escrow. Okay. So from Susan, Oh, Dr. Guiney. Can parents set up accounts for their children to pay off student loans? Uh-huh. Yeah. The child has to be 18 years old in order to execute one of these programs, though. So what does that mean? It means set it up for yourself, put it on yourself, and then run this, and then use it. Have your kids pay the money for the student loans into the program. You pull the money out and pay the student loan. That way you're capturing the money over and over and over and over again. All right. Can you set up an account for a young adult that has zero debt? Absolutely. Young adult, got to be, again, 18 years old. All right. And these are great programs to do like that for someone who's 18. And by the time they're 25, even I just did one on an 18-year-old that was a $65 a month program. By the time that young man is 25 years old, there's going to be $25,000 sitting in there for him, which is enough for him to make his down payment on his house that he's going to buy when he's 25 years old. Thank you, Merlin. How do you begin to write this on yourself? Either do it with Foresters, Lafayette Life, or Mutual Trust. Talk to your upline, have them help you with it. And if you need to see a DFL illustration, then you need to talk to a DFL certified individual who can run the illustration for you and has the software. Why did the demonstrator from Jason do it for 40 years? Because in both of those instances, the student loans that those people had was a 40-year-long student loan. And the student loans were in deferment, and they were deferring them until they could do some other things. So that's why it was going to take those two people 40 years to pay off their loans. Let's see. And on average, how many years after all debt is paid that the participant keep paying into the account? So that's something, when you're set these up, we do something called an RPU age, which stands for reduced paid up. And what that means is that's the year that the person, the account is written on, where they're going to stop paying into the program. Okay. And that can happen fairly early on. There's no rhyme or reason. It's just got to be at least 10 years or 7 or 10 years to avoid MEC. Let's see. Please talk about how a homeowner can use their escrow. Oh, Tom Deutsch. Okay. How a homeowner can use escrow. Okay. So right now, if you have a conventional loan, then the lender, as a nicety, lenders are who, Tom?
Lenders are evil.
They're banks and evil, right?
Okay. So I'm sorry.
Right. So the lender has decided, as a nice thing for you, they're going to allow you to pay them your homeowner's insurance premiums and your tax premiums. And they're going to keep that money, and they're going to put it into an account, and they're going to earn interest with it. And then eventually they're going to pay your homeowner's insurance, and they're going to pay your property taxes. Why?
And they're going to give us the interest that they earned, right?
No, they're going to keep the interest, right? So this is the same concept of when you first get your first job and you claim 0 on your W-2 because you want to get Uncle Sam to give you that big fat check at the end of the year to get a tax return, right? What are we doing? We're letting somebody hold on to our money and make money with our money for no reason whatsoever, just so we don't have to write a check. So that's what this is. So rather than put money into your lender and let your lender make money with your money, how much time do I have? I got 5 minutes. I'll show it to you. Hold, please. All right, here you go. These numbers are real. This is a real family that I did this for. This family pays $1,700 a month as a premium. That's their mortgage premium. Of that $1,700 a month, $888 is interest, $300 is principal, $168 are property taxes that are going into escrow, and $310 is insurance, homeowner's insurance. If you take just these two numbers, it comes out to $478. That means over the course of a year, they're paying $5,736 into an account that's owned by their lender, and the lender's making money with their money and eventually making the premium payment. So they're making money with my money. How much? I don't know. But here's what I know. If I had put that money into my DFL program without considering a dividend, without considering anything other than just the base 4%, I would have made $229 that year. So let me ask you this, Adrian, if you're walking down the street and you see $229 sitting in the gutter and there's nobody else around, are you picking it up or are you stepping over it? You're picking it up, right? All right. And we're going to Sizzler. So, so here's the deal. If I religiously put that money up into my private bank, that means the first year I'm going to deposit $5,736. With interest, that's going to come out to $5,965. And I'm going to take a loan. Remember, I'm not computing the dividend here. All I'm doing is the base cost, the base interest that I'm going to get minus the interest I'm going to be charged, which is 0.79% more than this. Okay. So that's why in the first year, I spent $5,736. I've got $5,965, but I actually lost $45. Okay. Let's do the math. If I made $229, but I lost $45, that means it cost me $260 some, right? That's okay. I'm okay with losing $45 to get the first year rolling, because in the second year, because of the effect of compound interest, I'm making money. And in the second year, I do the same thing, put in $5,736. I get paid my 4% guaranteed interest on the first year, the compounding of the first year and the second year, which is why at the end of the second year, I'm actually $195 up. In the third year, I'm $432 up for that year. Fourth year, $690 up for that year, and so on, getting all the way down to 15 years. So let me ask you this, Adrian, because let's say you pay off your mortgage quick, right? Do your taxes payments go away?
No.
Nope. Does your homeowner's insurance go away?
No.
No. You're still paying them forever, right? So if I showed you a way that, hey, look, here, Adrian, I'm going to give you $120,000, 119,449. I'm going to give you $120,000 in a retirement account. Okay. And I'm going to give you $4,500 minimum a year after 15 years, every year for the rest of your life. Remember, this is permanent, folks. Once the money goes in, we never pull the money out. The interest is always growing. It's always accruing, right? So I got $4,500 in here in year 15. In year 16, it's 5,000. It's 5,000. And in year 17, it's 5,500. So after 17 years of making my mortgage payments, if I make my mortgage payments regularly and pay that money to my lender and have it all be escrowed and have them take care of it all for me, I've got zero left to show for it. If I do it with a DFL campaign, I've got $120,000 sitting in my account and I'm earning $4,500 a year interest.
And you also have the money to pay the increases in the taxes and the insurance instead of having to be on a fixed income in retirement and not having the money to pay for it.
And let's say something happens and I get that call and the big man upstairs says, Forehand, it's time for you to come visit me. I'm going to take you away in 6 months. Okay. I'm taking $120,000 and I'm doing that trip of a lifetime. Or I'm taking $120,000. I'm going to find some other deserving soul and I'm going to change their life. Whatever. The point is, that's 120,000 choices that you had simply by changing the way you spend your money. To me, it's a no-brainer. Okay. So that is how you change and use an escrow to your advantage. You cannot do it with an FHA program until you're at 20% loan to value. You cannot do it with a VA loan, I don't think, but you can certainly do it with a conventional loan.
One of my clients is a VA loan, and it's not 20% loan, 80% loan to value yet.
Okay.
So,
okay. All right. Anything else here? We're done.
Althea has a question.
All right.
Althea has a question. Althea has a question.
Althea, last question. What is it? Then I got to run.
How do carriers determine eligibility and what's your average premium per month?
The average premium per month, there is no average. So when you run these programs, what we're looking for money that's being spent inefficiently. So, if you go to Starbucks 5 times a week, we're going to cut it back to 1 time a week. If you have a credit card that you owe $5,000 and you're trying to pay it off fast, so you're paying $300 a month extra, but you only had your minimum payment was $50, we're going to take that $250 difference. You're going to come back to the minimum, and we're going to have that $250 be part of the funding of your program. Okay. So there's lots of different places we find it. We might find life insurance. You're spending $200 a month on a $50,000 life insurance policy with a subpar carrier. Get rid of it. Spend the $50 a month here. Okay, so there's lots of places that we find the money where you're spending it inefficiently. There is no rhyme or reason as far as how much it is. The programs I've run have been anywhere from $65 a month to $25,000 a month. And then everywhere in between, depending on whether you're using it for a business function or a personal function. Okay.
Thank you, Scott.
All right. If I could just add to that, several of the programs that I've been working with families, they're already putting money towards paying down credit cards. All we're doing is we're taking it from going to the credit card and we're putting it into their DFL plan and letting it accrue there, and then use that money to pay the credit cards off.
Yep.
That's the low-hanging fruit. If you find a family that's already they're in debt. One of my families they're paying $535 a month. They were paying $535 a month against all their debts. All we're doing is we're putting it in here first. We're parking it. It's beginning to earn the interest. That's the low-hanging fruit, and that's almost a no-brainer. To do it that way, if they're already doing something.
I got one more thing to say, and then we got to go.
Okay.
Regarding what you just said, Tom, look, we all know people that are in debt. Everybody's in debt. Okay. And we all know people that are making active effort to get out of debt. Okay. So I have a woman that we just did one of these on. She's got $6,000 sitting in her bank because she was going to go pay off one of her credit cards. I showed her the math. Okay. So you can pay $6,000 today, and you'll save 1 month of interest. You're going to save $50. But if you put that $6,000 into your DFL program, let it sit there for 3 days, and then pull it right back out and then go pay your credit card off, you're going to make that $6,000 work for you for the rest of your life. And then I did the math. The math was, in 20 years, that $6,000 will have made her $29,000 worth of interest minimum. So what would it have cost her? If she'd done it, it would have saved her $59 in interest today, but she would have lost $29,000 in interest long-term. It's a no-brainer. So if you know people that are getting ready to do stuff like that, tell them, stop. Let's do one of these programs first. All right. Thank you, everybody. Have a great night. We're going to be doing the annuity training here as soon as I get this program done.
Thank you, Scott.